Donald Trump has made 2025 a remarkable year so far. In addition to talk about annexing neighbours Canada and taking control of Greenland and Panama, he has introduced big tariffs on commodities such as steel and aluminium, with the threat of more being imposed on global trading partners in April, sparking an inevitable trade war. The US's apparent resetting of relations with Russia, seemingly siding with Putin in the case of the war in Ukraine, has woken the UK and the EU up to the fact that countries who once relied on the US for their security are having to adjust their fiscal spending, taxes and borrowing to increase their defence capabilities. All this uncertainty has caused a shock to the global financial system, with increasing volatility from not knowing what move Trump will make next. US equity markets have seen large falls in the S&P 500, Nasdaq and Dow Jones Industrial Average over the last month or so. So if you think that this continued volatility, with the possibility of a recession, is the reality of how it will be for the 4-year term of the Trump presidency, then the 3 investment areas covered in this video might be of interest to you, to either provide you with protection hedging or big return opportunities to counter any decision the president might make going forward. As usual, there are markers in the timeline to get you to where you want to go in the video, and I'm not recommending any of the themes or investments featured today. This is a financial education video and not to be construed as financial advice. Please fact check anything that anyone tells you on YouTube, including what I say here in this video. Do your own research to find investments suitable to your own personal circumstances, and please seek the advice of a suitably qualified professional if unsure of anything. A bit later, I'm going to cover a theme that has provided massive returns so far this year, but firstly, let's look at another good performer for 2025, which is gold. Gold has truly stood the test of time, used across civilizations for thousands of years as a means of payment or for symbolic reasons. And more recently, gold has become a valuable commodity to meet investor needs. With estimates that only about 50,000 metric tons of gold is left to be mined globally, representing about 20% of the total gold that has ever been discovered, and with gold mining becoming more challenging as accessible reserves are depleted, this commodity will continue to be a scarce one, and that can surely only be a good thing for those who invest in it. But it's not just this scarcity alone that attracts investors, and those who hold a portfolio of equities or of equities and bonds often look to gold as a diversity tool. Diversification is like planting a garden with a variety of flowers, vegetables and herbs. If one type of plant struggles due to unexpected weather or pests, the others can still thrive, ensuring your garden remains vibrant and productive. This figure shows the correlation between various asset classes. In other words, how the price of one asset would be expected to move given an increase in another asset. A correlation of 1 here suggests that the 2 assets tend to move perfectly in sync, and 0 suggests no linear relationship between the 2 assets. So the lower that number, or correlation, the more useful the asset could be from a diversification perspective. As the price of gold tends to behave differently from many other asset classes, it's great for diversification and can help you to have a garden to be proud of. Investors also perceive gold to be a safe haven asset. When equity markets are at historically high levels, investors seek a possible cushion for fear of a market downturn. Demand for gold also often increases during times of political or economic uncertainty, or when conditions are volatile. And gold is sought after when interest rates are low or falling, and when bond yields are unattractive. It is therefore no coincidence that in 2025, the price of gold has risen by approximately 14% so far, reaching record highs of over $3,000 per troy ounce, according to Associated Press. With equity markets falling significantly in recent weeks, under a backdrop of continuing incoherent US policy causing uncertainty and volatility, you might feel that the return that gold is currently providing can be sustained or even bettered over the next few years, and that gold might be a stable and useful addition to your portfolio. Remember that gold, just like any other investment, is not 100% safe, and you may end up getting less back than you invested. Rather than needing to buy, store and insure gold bars, investors can get exposure through exchange-traded commodities, or ETCs, where investor money is pooled together to purchase an equivalent amount of gold bars, which are then held in a safe custody in a bank vault in an account designated for the ETC. The value is then based on the market gold price, less the fund management fees. The Ishares physical gold ETC with the ticker SGLN and a low OCF of 0.12% is an example of a gold ETC that is widely available on investment platforms such as Trading212 and InvestEngine. But there are many more alternatives out there, and this one is just a starting point for your research, not my recommendation. The next theme could be the growth sector that competes with technology over the next couple of years, and it's defence, which is increasingly on investors' radars. This is understandable, given how many countries are increasing defence spending in 2025, to not only fill a hole that would potentially be left by the USA wishing to redirect global defence spending to domestic issues, but also in preparation for a growing sense of geopolitical instability. This has been caused by numerous high-profile conflicts from Europe to the Middle East to growing tensions in Asia, and exacerbated by Donald Trump's demands that NATO countries increase their defence spending and that European countries will be expected to play a bigger defence role in wars that are taking place on their doorstep, such as the conflict between Ukraine and Russia. This uptick in defence spending is expected to filter through to the earnings of defence companies, and there is potential for longevity with this theme. Russia's full-scale invasion of Ukraine in 2022 confirmed without doubt our entry into a new geopolitical paradigm. The invasion shocked European NATO to its core, upending assumptions that had led to reduced defence spending over the last 3 decades. This conflict has proven to be a catalyst for many countries across the world, converging into almost Cold War-style blocs, requiring Cold War-style military spending. It is estimated that European NATO and Canada will increase their defence spending by about 18% this year. And on the 18th of March, lawmakers in Germany, Europe's largest economy, voted to allow a huge increase in defence and infrastructure spending, going against their strict debt and fiscal rules. So if the defence sector is of interest to you, according to FinanceChart.com, the select STOXX Europe Aerospace and Defence ETF with the ticker of EUAD, which is available in Europe, has shown year-to-date returns of over 48%. For UK investors, HANetf Future of Defence UCITS ETF with a ticker of NATP has returned 20.32% year-to-date as an alternative and is available on investment platforms such as Trading212 and InvestEngine. Remember that the past performance in these ETFs should not be used as a reliable indicator of what will happen in the future and are for guide purposes only. And research of these ETFs alone will only get you so far. You will have to decide where defence spending is going over the next few years as we move forward into this new uncertain era. And if you are finding the content of this video interesting and useful, then it would be great if you would consider hitting that like button, subscribing to my channel, and to turn on notifications so that you'd be aware of when I post new content. The last theme makes an assumption that the US oil and gas industry will be given a boost if the words "drill baby drill" that were uttered by Donald Trump in his inauguration address are anything to go by. He has consistently supported the oil and gas industry, emphasising energy independence and economic growth. His administration is rolling back regulation to encourage drilling and production, including drilling and production on federal lands, and he promotes policies aimed to boost domestic energy production. Worldwide, countries are adapting government policy to set more realistic green targets, with old, abandoned oil drilling contracts sometimes being reinstated. The Ishares Oil and Gas Exploration and Production UCITS ETF, with the ticker of SPOG, contains the largest publicly traded companies involved in the exploration and production of oil and gas from around the world. The SPDR MSCI Europe ENGE UCITS ETF, with the ticker of ENGE, tracks large and mid-cap European companies from the energy sector, with global companies Shell and BP accounting for about 53% of the index. Performance year-to-date of this one is just under 9%, with 5-year returns of over 165%. But if you want more sector diversity in an ETF, you can get decent exposure to BP and Shell through a low-cost FTSE 100 ETF, such as the Ishares Core FTSE 100 UCITS ETF, with the ticker of CUKX. Remember that the US's change of policy to the benefit of oil and gas companies will not necessarily increase industry returns, despite it being the largest global economy. Actual commodity returns generally depend on various factors, including market conditions, oil prices, and global supply dynamics. Well, there you have it. 3 ways in which you can try and keep ahead of the curve by investing in themes that either act as safe havens from current volatility or take advantage of US policy and current geopolitical instability. For me, with a longer-term investing mindset, a bit of everything is my preference, as I just want to keep my portfolio as diverse as possible and not concentrate it too much in any one direction. So exposure to gold, defence, or anything else would be a small percentage to enable me to keep my overall investment portfolio balanced. I would be interested to know what you think, and please let me know in the comments. Thanks very much for watching.